The 10 days that decide whether you retire rich or retire broke. Somewhere out there right now, two people are sitting in front of the exact same brokerage account screen. Same starting balance, same monthly contribution, same target retirement date 20 years from today. If you looked at their accounts on the day they opened them, you could not tell them apart. One of them is going to retire with comfortable money. The other is going to retire with roughly half of that. Same market, same 2 decades, same fees, same fund, same everything except one thing. Somewhere in those 20 years, the market is going to have a terrible week, maybe a terrible month, the kind of stretch where the news anchors look genuinely worried and your retirement account loses an amount of money that used to take you a year to save. One of these two people is going to look at that red number and sell. The other is going to do absolutely nothing. That single decision, made on a handful of days neither of them can predict in advance, is going to be worth more to their retirement than every other financial decision they make combined. More than which fund they picked, more than their savings rate, more than their salary. My name is Nick. Today, I'm going to show you exactly which days these are, why you can never know which ones they're going to be until they've already happened, and why understanding this one piece of math might be the most important thing you ever learn about money. Let's start with the data, because this isn't a theory. This is one of the most repeated, most uncomfortable studies in all of personal finance, and once you've seen the numbers, you cannot unsee them. JP Morgan ran an analysis on what happens if you invest in the S&P 500 and simply leave the money alone for 20 years, fully invested, never touched. Over that stretch, the historical annual return comes out to somewhere around 10.6%. That's the baseline. That's what patience alone gets you. Now, here's where it gets interesting. If you miss just the 10 best single trading days during that entire 20-year period, 10 days out of roughly 5,000 trading days, your annual return doesn't dip a little. It collapses to around 6.4%. Miss the 30 best days, and you're down to 1.5% a year, which means you would have been better off in a savings account doing nothing at all. Let that sink in for a second. 10 days out of 5,000. The difference between those 10 days being in your portfolio or not in your portfolio is the difference between a comfortable retirement and a genuinely difficult one. In one version of this study, covering 2003 to 2022, a buy and hold investor who started with $10,000 and never touched it ended up with about $64,800. The investor who missed just the 10 best days during that same period ended up with around $29,700, less than half the money for missing 10 days. This is not a hypothetical. This happens to real people every single market cycle because of one psychological trap that almost nobody sees coming until they're already in it. Here's the part that turns this from an interesting statistic into something genuinely important for your own decisions. You might be thinking, fine, I'll just be careful not to miss those days. I'll watch the market closely and I won't sell during the bad ones. You will. Not because you're undisciplined, because of a mechanism that is almost comedic in how cruel it is. The best trading days in market history and the worst trading days in market history are not opposites sitting on opposite ends of some calendar. They are neighbors. They show up at the same parties. In that same JP Morgan study, 7 of the 10 best market days happened within 15 days of the 10 worst market days. Think about what that actually means. The market crashes. You watch your account drop 5, 6, 7% in a single session. The news is calling it historic. Your hands are sweating a little when you open the app. Every instinct you have is screaming at you to get out before it gets worse. And the moment you act on that instinct, the moment you sell to protect what's left, you are statistically standing right next to one of the biggest rebound days of the entire decade. Not eventually, not someday, often within days of the crash itself. The market doesn't crash and then calmly drift back up over a comfortable 6 months while you watch from the sidelines feeling vindicated. It crashes, and then it frequently snaps back hard and fast, almost daring you to have already sold. This is why panic selling is so devastatingly effective at destroying returns. It's not that people sell and miss a slow recovery. It's that they sell directly into the window where the recovery's best days are about to happen, and then they sit out exactly the days that would have made the crash forgettable. Let me show you what this actually looked like in real life, because numbers in a study feel abstract until you put them on a calendar. In March 2020, as COVID lockdowns began, the S&P 500 fell about 34% in just over a month. It was one of the fastest crashes in market history. Headlines were apocalyptic. Unemployment was spiking. Nobody knew how long this was going to last or how bad it was going to get. A lot of people sold during that window, completely understandable in the moment. The world genuinely looked uncertain in a way most people alive had never experienced. Here's where it gets almost cruel. The market bottomed on March 23, 2020. The very next trading day, the S&P 500 jumped about 9.4%, one of the best single days in market history. A few days after that, another massive gain. Within 5 months, by August 2020, the market had fully recovered everything it lost and was sitting at new all-time highs. Anyone who sold near the bottom in late March, convinced things were about to get even worse, locked in their loss and then had to watch from the sidelines as the market roared back faster than almost anyone predicted. The people who did nothing, who left their portfolio exactly where it was, through the most terrifying month of the entire event, were made whole within months. The people who acted on their fear got the crash and missed the recovery, which is the single worst possible combination of outcomes available in the entire scenario. This pattern isn't unique to 2020. It happened after the 2008 financial crisis. It happened after the dot-com crash. It happened after Black Monday in 1987. The shape is always roughly the same. Sharp pain, followed faster than feels reasonable by some of the best days the market has to offer, available only to the people who were still standing there when it happened. Amos, why does this keep happening to smart, capable people who know better in the calm light of day? Because investing decisions are never actually made in the calm light of day. They're made in the moment, with your real money, while red numbers are flashing on a screen and a part of your brain that evolved to escape predators is telling you that fleeing is the responsible adult thing to do. There's a research firm called Dalbar that runs an annual study comparing what the stock market actually returned in a given year versus what the average investor in stock funds actually earned. These numbers should be nearly identical. The market goes up 25%. You'd expect investors broadly captured close to that 25%. They don't. In one recent year, the S&P 500 returned just over 25%, while the average equity fund investor earned around 16.5%, a gap of roughly 8.5 percentage points. That's not fees. That's not bad luck. That's behavior. People bought after prices had already risen, sold after they'd already fallen, sat in cash waiting for things to feel safe again, and then bought back in, later and more expensively than if they'd simply stayed put the entire time. The market doesn't punish people for being unintelligent. It punishes people for being human in a system specifically designed to reward the appearance of doing nothing. Now, here's the genuinely good news buried inside all of this, because I don't want to leave you feeling like the market is some sadistic trap designed to separate you from your money. It isn't. It's just indifferent. And indifference is something you can actually plan around. You don't need to predict the 10 best days. Nobody can. Professional fund managers with research teams and Bloomberg terminals can't do it consistently, and you're not going to do it from your phone during a panic either. The goal was never prediction. The goal is presence, simply being invested on every single day, including the terrible ones, because you cannot separate the 10 good days from the surrounding bad ones without a crystal ball nobody owns. The actual fix for this entire problem is almost insultingly simple, and it works precisely because it removes you, the panicking human, from the decision-making process entirely. Automate your contributions so they happen on a schedule regardless of what the market did that week. When the market is up, your fixed contribution buys fewer shares. When it crashes, that same fixed contribution suddenly buys more shares at a discount. You don't decide this in the moment. It was decided months or years ago when you set up the automatic transfer, back when you were calm and rational and not staring at a 15% drop in your retirement account. And before any of this even becomes a live test of your willpower, decide in advance what you're going to do when the crash comes. Not if, when. Write it down somewhere you'll actually see it later. Something as simple as, when the market drops significantly, I change nothing, and my automatic contributions continue exactly as scheduled. That sentence, written by the calm version of you today, is worth more than almost any other piece of financial planning you'll ever do, because it's the thing that's going to talk you out of the worst decision of your investing life at 2 in the morning when the calm version of you is nowhere to be found. Let's go back to our two investors from the beginning, because now you can see exactly what separated them. Investor 1 set up an automatic monthly contribution into an index fund the day they opened the account and never touched the settings again. Over 20 years, the market did what markets do. It had incredible years. It had a couple of genuinely frightening crashes, and through all of it, the contributions kept landing on schedule, buying shares at whatever price was available that day, good or bad. They never tried to time anything. They weren't being especially brave. They were simply absent from the decision-making process by design. Investor 2 had the identical setup at the start, but during one particular downturn, watched their account drop and made a manual decision to move everything to cash, telling themselves they'd get back in once things settled down. Things did settle down eventually, but by the time it felt safe enough to get back in, the market had already climbed well past where they'd sold, and a meaningful chunk of the best days in that recovery had already happened without them. Same starting point, same 2 decades. One decision, made on what felt like one reasonable day out of thousands, was the entire difference between the two outcomes. Investor One's 20 years compounded smoothly into a number that funds an actual retirement. Investor Two's 20 years compounded around a gap, and that gap, quietly, permanently, became the difference between retiring comfortably and not. Here's what I actually want you to take from all of this. The 10 days that decide whether you retire rich or retire broke are not a secret formula waiting to be cracked. They're not a pattern you can study your way into predicting. They are, by their very nature, unknowable in advance. And the moment someone tells you they can identify them ahead of time, that's the moment you should stop listening to that person entirely. The only strategy that has ever consistently worked is the one that doesn't require you to know anything about which specific days matter. Stay invested all the time, through the good years and the bad ones. Let the automatic contributions do the unglamorous work of buying shares on schedule, regardless of what the headlines say that week. And when the inevitable, terrible week arrives, and it will, remember that the worst thing that has ever happened to long-term investors wasn't the crash itself, it was leaving right before the recovery. I'll see you in the next one.